Thank you, Mr. Chair, for giving me the floor. Distinguished delegates, on the behalf of Allianz Süd and the Global Alliance for Tax Justice, I'd like to speak today on the interconnection between tax-related illicit financial flows, tax avoidance, tax evasion, and sustainable development. I do this with the perspective of an organization working on financing for development and tax justice based in Switzerland, the one country who can, according to a current report by the Boston Consulting Group, still call itself the biggest financial center for cross-border wealth, closely followed by the Asian hubs Hong Kong and Singapore. In the spillover ranking of the Sustainable Development Report 2025, delivered by the Sustainable Development Solutions Network SDSN, which measures the positive and negative effects domestic policies in a specific country can have on the progress of the Sustainable Development Goals in other countries, Singapore and Switzerland, together with Luxembourg and the Netherlands, are right at the bottom of this ranking due to their size as offshore financial centers and destinations for profit shifting of MNEs. As we already highlighted for several times in this committee, and as it also has been widely acknowledged by several of you, distinguished delegates, forums such as the FATF, the OECD's Global Forum, and the Inclusive Framework are unable to deliver on effective tax and finance policies which lead to the fulfillment of sustainable development and human rights obligations. If we take the standards regarding combating IFFs developed over the last 10 years in the context of UN financing for development processes, these countries made scarcely any progress in the respective areas. The main offshore financial centers have never acknowledged the gaps highlighted in the SDSN reports and stick to its opinion that under the term illicit financial flows, only illegal flows should be considered. This dismisses any attempt to fight profit shifting by multinational companies or problematic cross-border offshore structures manufactured and managed by banks and other financial and non-financial intermediaries in the hereby outlined discussion. Furthermore, as recent Swiss legislation for the implementation of a national beneficial ownership registry in line with the FATF recommendations 24 and 25 and respective due diligence requirements demonstrates, standards defined by the FATF are strongly insufficient to tackle IFFs for the sake of enforcing sustainable development and human rights improvements or tackle negative finance-related spillover effects. As we all know, this is also the case in respect to the OECD standards in regard to information exchange and BEPS. Though the Swiss BO register is supposed to live up to FATF standards, it falls short of being a useful instrument in the battle against IFFs as they are described by several international organizations, such as, for example, the IMF. First of all, its access is extremely limited and not even includes all federal departments for whom the data in it could be useful, not to speak about qualified stakeholders or the general public. Secondly, and among other weaknesses, no measures have been taken to systematically control the quality of the submission data by financial intermediaries. I guess my conclusions following from this are self-evident. These negotiations are the place to fill those gaps in our global common struggle against IFFs. In light of the fact that this session is the last one before the publication of a comprehensive draft text in July, as it is planned, the development of the respective language gets more urgent. In our opinion, Article 7 in the current form is falling short of defining grippy rules for effective forms of information exchange and transparency. Thank you very much.